This is Chapter 3, homework problem number 1 out of 5. So here we go. We've got recall that says Touch Gear had estimated $1,055,000 of manufacturing overhead for the year and 64,000 direct labor hours, resulting in a predetermined overhead rate of $22 per direct labor hour. So they've already calculated the predetermined overhead rate, so they're not going to make you do that. But usually what you'd have to do is you generally have to take the estimated overhead which they gave you, which in this case is $1,055,000, and you would usually divide that by 64,000 direct labor hours. So after I looked at this particular problem, it looks like there's actually a typo in their calculation, because if you do divide the $1,055,000 by the 64,000, you do not get $22. But having said that, just you need go ahead and use this number as is anyway. And so that's going to be your rate. So in case you're trying to validate where they get that rate, I don't know myself. I think there was some sort of typo, but you'll need this rate. And then it says by the end of the year, they had actually incurred $950,000 of overhead, and they had used 63,000 direct labor hours on the job. The question is how much had Touch Gear either over allocated or under allocated overhead for the year? So notice they've already given you part of it. They already gave you the actual overhead. So 950, you can just plug that in here. So you're going to have to calculate the allocation. So what you'll do is you'll take that $22 rate per direct labor hour, and you're going to multiply that by the 63,000 actual direct labor hours incurred. So when you do that, you're going to get the 1,386,000. That's going to be your allocated overhead. That's going to go right there. So you compare that to the actual, and notice you're going to be, in this case, you're comparing actual to what you allocated. You're actually over allocated by the difference. So the over allocation is going to be 436,000, and they want you to use a parentheses in there to indicate over allocated, and that's basically how you solve it. So again, rate, which is the $22 per direct labor hour, times the activity, which they gave you, that gives you your allocated overhead. Again, last thing, remember, normally the rate you would generally have to calculate. I believe there's a typo in this particular problem in terms of how they got the rate, because if you tried to verify the rate, 1,055,000 divided by the 64,000, you do not get $22 per direct labor hour. But in any case, after I didn't discover this until after I had already assigned it. But in any case, just use the $22 as your overhead rate, multiply by your activity to get the allocated overhead, and then you compare that to the actual, and then that will give you the difference. Will be, in this case, over allocated overhead by 436,000. This is Chapter 3, homework problem number 2, and this is going to be a series of transactions. So what I went ahead and I've already clicked on this icon, so all the transactions are listed right here. We've got 1 through 10, and on this particular slide we're going to go through transactions 1 and 2. So number 1, it says during March, $120,000 of raw materials were purchased on account. That's going to be in accounts payable. So because you're buying inventory, you're going to be debiting raw materials for 120 and crediting accounts payable for 120,000. This is basically just like your financial accounting, or what in the general transactions you would have done in either applied accounting or financial accounting. So that would take care of transaction number 1. Transaction number 2. Notice it says during the month 139,500 of raw materials were requisitioned, and it says of this amount 134,500 was traced to specific jobs, while the remaining materials were for general factory use. I'm kind of reading up here. So basically, the 134,000, that's going to be a direct material, and because it was specifically traced to the job, while everything else is going to be indirect. So just remember, anything that's direct goes to work in process. So work in process gets debited. There's your direct material that's going to get debited for the 134,500. The difference, the 5,000, goes right into your manufacturing overhead. So there's your $5,000 debit there. And then you're going to basically credit it out of raw materials inventory as you're moving these cost flows into the next department. So that would be transaction number 2. Okay, so this is going to be transactions number 3 and 4. And notice on transaction number 3, again, I'm just going to read over here because we can read the whole thing. It says, manufacturing labor, both direct and indirect, for the month total $80,900. It has not yet been paid, and says of this amount, 64.4 was traced to specific jobs. That means that's direct labor. So again, once again, anything direct goes to work in process. So the 64,400, there's your direct labor, gets debited to work in process. The actual overhead, the indirect labor, goes to overhead. So you get the debit there of 16,005, and then it says of the 80,900 you have not paid for it yet. So you're going to basically put that into a payable. So you're going to put that into salaries and wages payable. Transaction number 4 says the company recorded $7,800 of depreciation on the plant building, and it says in addition $2,300 of prepaid property tax expired during the month. The company also received the plant utility bill for $6,000, which will be paid at a later date. So guys, all this stuff is overhead because it's all that indirect cost. It's not specifically traced to a job. So if you add up these costs, 7,800 plus 2,300 plus 6,000, that's $16,100. You're going to debit all that into overhead. The credits go here. You're going to credit accumulated depreciation for the depreciation. The property tax, it's a 2,300 credit because that was an expiration. That's like an adjusting entry. And then accounts payable for $6,000 on the utility bill. And that's essentially going to take care of transaction number 4. Now, one more thing in case you were wondering how you knew that it was overhead. Usually when you see anything that's attached to the plant, building, or factory, that's going to be considered overhead. Okay, so now we're going to look at transactions number 5 and number 6. Number 5 says manufacturing overhead was allocated to jobs using a predetermined overhead rate of 75% of direct labor cost. Hence, the total direct labor cost is found in requirement number 3. That's going to be that 64,400. So in this case, to do the allocation, you're going to simply take it says 75% of direct labor cost. So what you do is you take the 64,400, that's your activity, and basically multiply that by 0.75. That's going to give you your overhead allocation. So you debit that to work in process, and the credit goes to manufacturing overhead. So that's transaction number 5. Transaction number 6 is where you're basically completing jobs. It says several jobs were completed. It says according to the job cost records, these jobs cost $255,000 to manufacture. So to move it on from work in process, you're simply going to debit finished goods inventory for $255,000 and credit work in process for $255,000 for the jobs that you completed. All right, this is going to be transaction number 7. It's on your sales. So we've got sales all on credit for the month for $380,000. According to the job cost records, the units sold cost $238,000 to make. Assume the company uses a perpetual inventory system. So 2 separate entries, one to deal with the sale and the other one to update the inventory. So the actual sales are pretty simple. This is just like financial accounting. Debit accounts receivable, credit sales revenue for $380,000. That's for the sale. So then for the cost of the sale or the cost of goods sold, you're going to debit cost of goods sold for the cost, which is $238,000, and simply credit finished goods since you're moving it out of the warehouse, again for $238,000. Okay, so this is going to be for transactions 8 and 9. Transaction number 8 says the company incurred operating expenses of $20,000 during the month. It says assume that 60% of these were for marketing and administrative salaries, and the other 40% were for lease and utility bills related to the corporate headquarters. So guys, everything in 8 are considered period costs. These are non-manufacturing. So everything here is going to be expensed right away. So the accounts we're going to basically be wanting to use is the way you come up with the amount is you got the 20,000 and they gave you the allocation, so multiply by 60%. That's going to be 12,000. That's going to be for your salaries expense. So debit your salaries expense for the 12,000. And then the other 8,000, they're going to give you use lease and utilities expense. Just combine those, put that for 8,000. And in this case, it says incur. That means you haven't paid for it yet. So you have 2 payables: a wages payable credit for 12,000, and then a simple accounts payable for 8,000. So that would take care of transaction number 8. Now, number 9, it says In order to prepare its March financial statements, the company had to close its manufacturing overhead account. So if you go back and look at all the entries from 1 through 7, look and see what happened to manufacturing overhead. Remember, the debit part of overhead always gets the actual cost, and the credit part of it gets the allocated part. Okay, so if you go back and look at your allocated overhead, that was, I believe, in transaction number 5, that gave you the 48,003. You had 3 other items listed in terms of the transactions. That's your actual. So basically what happens here is you end up with a credit balance of 10,700. So what's going to happen then, and I'll show you this in the next slide, is you have to close out this overhead to cost of goods sold. So to close it out to 0, you're going to be debiting the manufacturing overhead and crediting cost of goods sold because you were over allocated. So we'll show this again on the next slide. All right, so again, as you can see, to get this account to go to 0, you would debit overhead for 10,007 and then credit cost of goods sold for 10,700. That would be transaction number 9. All right, so you have to go back and just review your other journal entries, but when you look at your financial statement on your income statement, you'll note that you've got your sales of 380. That would have been right from transaction number 7. Your cost of goods sold would have been a combination of the 238,000, and remember how you would have updated it when you closed out that overhead. So once you get your updated cost of goods sold, you get your, subtract that from sales to get gross profit, and then all of your other operating expenses were essentially listed in number 8. That's all your period cost. That's 20,000. You would subtract that to get your net income, or operating income of 132,700. This is chapter 3, homework problem number 3. Question says would the following companies use either a job costing or process costing? So remember, job costing is for unique types of goods, unique types of jobs, custom made types of jobs. Process costing would be for like mass producing homogeneous types of items, and you'd be using more of an averaging type of technique. So think of kind of like your process companies like potato chips or the soda beverages that you might buy at a supermarket. So you got A through E. Let's go through these. Letter A says a legal firm. Guys, that would most likely be job costing because you would have specific customers who have unique needs. So you'd retrace that basically to a specific job. So legal firms most likely would be using job costing. Oil refinery, that's like a mass production of a similar unit. That's going to be processed. That's going to be more of an averaging technique. Letter C says a commercial plumbing contractor, most likely job, because they're going to go to a specific location and build that location based on specifically what they're completing. That's going to be a custom type of job, so that would be job costing. A cereal manufacturer, again, that's a process costing. That's kind of like, like I said, the beverages, the chips, cereals would fall into that category. And think of like mass production, that's going to be more process. And then finally, I kind of mentioned this word earlier, custom home builders. That's going to be job costing. This is chapter 3, homework question number 4. This is going to be looking at your cost flows. So this is a manufacturing plant that make tables, benches, and furniture. And they want to know how each of the inventory accounts would be affected by the following actions. So notice they give us raw materials, work in process, finished goods. So letter A says lumber is delivered by the supplier to the plant where it is stored in a raw material storeroom. You're going to be increasing raw materials inventory. You just purchased it, so that would be a plus or an increase. Part B says the lumber is requisitioned from the storeroom to be used for tops and tables. Guys, that's most likely going to be direct material. So you'd be decreasing the raw materials, and that's going to move right over to an increase in the work in process because you're starting to work on the product. Letter C, it says factory workers cut the lumber for the tables, most likely direct labor. That's going to be an increase into work in process. Letter D, 5 tables were completed and moved to the inventory storage area, so you're going to be moving them out of work in process. So you most likely would say decrease work in process and increase finished goods. Finally, it says a customer purchased a table and takes it home, so you're going to take it out of finished goods. That's going to be a decrease, and the offset usually would go to an increase to the cost of goods sold account. Okay, this is chapter 3, homework question number 5. It says Carlton Industries makes wooden backyard playground equipment. At the start, they give you all their estimates, so you have 1,830,000 of your estimated manufacturing overhead and 2,160,000 of your estimated direct labor costs for the year. And the next sentence says, after the year was over, they had indicated in the accounting records that this is what happened. The actual overhead was 1,007,000 and the actual direct labor cost was 2,550,000. Three parts to this problem. Number one, they want the overhead rate. Assume that they use direct labor cost as the base. Number two, it says how much overhead would have been allocated during basically to the jobs during the year. And then number three, they want to know if it was either going to be overhead allocated, over allocated, or under allocated. So down here, part one, here's your basic formula on calculating your predetermined overhead rate. They gave you the estimate, which is 1,830,000. You're going to divide that by the 2,160,000, and then they want this as a percent. So when you actually divide that, you get like 0.8472, keeps going. Just move the decimal over 2 places. 84.72% is your overhead rate. Number two, once you've got that rate, you take the rate times, notice the actual activity, which was given at 2,550,000. So in decimals, if you take the 0.8472, multiply that by 2,550,000, you get your allocated overhead of 2,160,360. Last part of the problem is you're going to compare this allocated amount to the actual. Again, they gave you the actual, which was, in this case, 1,700,000. So if you look at the T account, notice the debit part gets the actual, the credit part of overhead gets the allocated. In this case, actuals 1,007,000, allocated was 2,160,360. So you're going to be over allocated by the difference of $460,360,000.